The mission is to try to address this issue of labor exploitations in supply chains of multinational corporations by making investments in technological innovations that can enable better visibility and better transparency into labor conditions, multiple tiers down into an extended supply chain.
As shareholders, we have certain rights to actually ask these companies to reduce the material risk to all stakeholders. When Walmart makes a decision, all their employees, all their customers, their entire supply chain, millions of people are impacted. And if that decision is good for all those people, all those employees, all those customers, all those supply chains, the communities where they operate, and for shareholders, then it's a win-win.
We've played a mix of roles because I think, in an emerging sector, you almost need to dive in and play whatever role you need to. I would say the one thing, that's sort of not helpful about the name social impact bond is that it doesn't really operate like a bond. It operates more like project finance.
Bethnal Green Ventures, we set out to invest in and support founders who want to use technology to have a positive environmental, social impact and build high growth companies.
The Working Capital Innovation Fund, is that a fund? Was that like incubated under Humanity United and then you set up Working Capital Fund outside of that?
Yeah. So Fund 1 was incubated within Humanity United. And as I'd said, the general partner actually was the foundation. And then in 2020, we spun out and became an independent entity and launched our second fund. And that is more commercially oriented, and it is not a PRI vehicle. So it's not a program-related investment vehicle where we can both accept, it's a blended structure. So there's for-profit limited partners, as well as those who are more philanthropically oriented. And so we can make program-related investment if necessary, but largely we are just making investments that are free of side letters. Yeah.
Do you have a mission? Could you just bullet point the main activities that you guys are focused on?
Yeah, I think the mission is to try to address this issue of labor exploitations in supply chains of multinational corporations by making investments in technological innovations that can enable better visibility and better transparency into labor conditions, multiple tiers down into an extended supply chain. As I mentioned before, I think the fundamental issue we're dealing with is an issue of outsourced production in a global economy where there's insatiable demand for cheap goods at scale, which has led to very complex, opaque supply chains in virtually, every industry and in every geography that goods are produced. And so our mission is to try to create a world where there is visibility, is accountability, and there are ultimately fair labor conditions and equitable labor conditions, all the way down to the bottom of the supply chains where, often some of the worst exploitation occurs at the commodity level and some of the input levels.
You also have established a second fund, right?
Yeah, we launched a second fund and, have many of the same limited partners as well as some additional limited partners there. The emphasis has been largely the same. I think that we've evolved and the field has evolved in certain ways. So, as I mentioned earlier, I think we did things when we were underneath the umbrella of a foundation that would have just had a different return profile, maybe a different risk profile. And as we've entered into the second fund, we're much more commercial returns oriented, understanding that there are still impact imperatives in terms of what we need to achieve. But certain types of investments that we entertained in Fund 1, we wouldn't have entertained in Fund 2. And one of the real challenges that we had faced in our work historically had been that ignorance was bliss for many companies. The less you know, the less liability you have, the more you can distance yourself from scandals. And so, as you're trying to push better visibility, better transparency onto companies, some, would do the right thing, I think, out of their desire to be positive, ethical actors, but many didn't. And now what you're seeing is this is going to be a requirement for, tens of thousands of companies to all of a sudden, know who is in their supply chain and then have done some sort of diligence on to their riskiness. And, if there are problematic suppliers, trying to address some of those problematic behaviors. And so what that does for our work is it took what was, I think, a smaller total addressable market, and all of a sudden has made it much more significant, which means I think for us, a lot more opportunities to invest both at that nexus of deep impact where we still want to focus, but also knowing that the commercial viability and the demand for that kind of product is going to grow considerably.
What's your AUM in the second fund?
27. So we have 50 million across both Fund 1 and Fund 2.
Is that total AUM then for working capital fund?
Total AUM, yeah.
Okay. And were there any change in your mix of investors in Fund 2 from Fund 1, or was it all the same people or same types of people?
No, we've had some new investors come in. We've had Mindaru from Australia, from Andrew Forrest, who was in the mining industry, has made his fortune, and he's been a big advocate for labor rights and human rights over the years. And we also have had LGT come in as well.
So tell me, why is Working Capital Fund focused on investing in companies that addressed forced labor and extended supply chains of multinational companies? Can you make the scale of this problem understandable to even me? I understand, in the big picture, but how big is this and where is it? Where is it all sitting?
We often say, labor exploitation is a feature and not a bug of the global commerce system. Again, largely because you do have this demand for cheap goods that, drives corporate action, and you have outsourced production, but you also have outsourced accountability. And, you look at the downward pressure on salaries and, the need to be able to compete on price. And, ultimately a lot of those pressures gets pushed down to those who are most vulnerable. So the scale of the problem really cuts across industries. If you look at, electronics, if you look at apparel, if you look at, you look at Asia, Southeast Asia, you look at Africa, you look at South America, really regardless of the geography, regardless of the industry you're working in, the risks of forced labor and labor exploitation are significant. There are estimates, there's the global slavery index, there's estimates of number of people who are living below living wage. The overarching level of vulnerability, though, within supply chains, I think, is significant. Whether you have, tens of millions, I'm trying to remember what the most recent global slavery index number, I think it's in the, 60 million people who are in situations of slavery. But that doesn't even begin to really scratch the surface in terms of the, hundreds of millions of people who are in different forms of severe exploitation. That could be wage theft, that can be, forced overtime, that can be, a variety of other things. It could be child labor that really go into the production of the things that we purchase and the things we produce. So the scale is really, significant across many, many sectors. And it's not just, pertinent or relevant to just a few.
And we're talking primarily third world countries or developing nations.
Yeah, largely, yes. Most of the world's production has been outsourced. Often there's a bit of a race to the bottom in terms of, limited regulation and cheaper prices. And that's where there are very few worker protections and where a lot of the most extreme exploitation occurs. Yeah.
What is then the long-term cost of ignorance to these multinationals? If you say that they don't want to know, what is the cost that they don't know about or that they don't see?
Historically, the cost has been limited, and I think that's been part of the problem. Obviously, there's always the risk of consumer pressure, and there's risk of kind of reputational risks. But, there hasn't been any meaningful penalties for being negligent, or at least there haven't been sufficient penalties for being negligent in terms of, what would really, I think, change corporate behavior. That's why I think some of the changes that are currently in the works are so promising, because now, for example, as much as 5% of your annual turnover could be at risk if you were to have found exploitation in your supply chain. It was to be uncovered and you had not done sufficient diligence, or you hadn't basically been thorough in your efforts. That all of a sudden changes the calculus. Historically, as I said, there had been a lot of incentives to not know. I think if you look at, the different divisions within business, and you have compliance, and you've got your legal, and you've got your responsible sourcing. Often you don't want to have too much information about bad things that you've discovered unless you've been able to take action on them. And so sometimes there was more of an incentive to just do the bare minimum, be able to check the box in terms of compliance, but not actually take that additional step.
And you said there's regulations being developed against exploitation now. Can you give a clear definition of, how exploitation is defined?
For us, we look at, broadly worker welfare and worker vulnerability. As I said, it's not just the most severe cases of modern day slavery, but it's wage theft, it's forced overtime, it's sexual exploitation by managers on the assembly line, a certain basic level of living wage income. So it's a sort of a combination of those factors. Ultimately, this exploitation occurs when there's vulnerability, and that vulnerability can derive from a variety of different sources. It can be economic, it can be gender, caste, it could be migratory status, which is a huge issue, one that again we've tried to address through some of our investments. So all of those factors that drive vulnerability ultimately, create a workforce that can be exploited and that has limited voice and limited ability to push for some of the basic requirements needed to sustain a livelihood.
Out of curiosity, what happens when you go to dinner parties? You're in East Bay, right? When you go to dinner parties in the peninsula and the valley, and you tell people what you do.
I think the general reaction I get from people is usually that it's very compelling. It sounds like it could be potentially very impactful, but it sounds also very narrow and very niche. And I actually think that's anything but the case. I think if you look at, again, the way business is organized at a systemic level now, that the vast majority of a corporation's impact on the planet and on people is indirect, right? So, over 70% of your carbon emissions will be in your scope 3, supplier base. If you look at most companies, somewhere between 80 to 90% of their workforce is going to be indirect workforce, the workforce of their suppliers. And so if you're really looking at trying to make a positive impact on people at scale, there's no better way to do that than starting at the top of the supply chain with large-scale multinational corporations that have leverage and can demand and drive certain behavior change all the way down to the bottom of the supply chain. And so I think that's why we feel this is such a unique opportunity and why it's also potentially so scalable and, as a consequence, also potentially quite profitable if you get investments that can help reinforce those behaviors.
That's what I want to get into now. So what is the fund's theory of change for addressing this problem that you've sketched out here? And I guess I'd like to know, or I'd like you to explain how venture capital in the financial markets can address forced labor and labor exploitation in the global supply chain.
The investment thesis is pretty straightforward, which is we think there's growing demand for better visibility into labor conditions within your extended supply chain. And that demand, again, as we've touched on, can come from consumer preference, that can come from legislation, and that can come from brand risk. But there is increasing demand. It's increasingly a priority for companies. The tools currently used are inadequate. So if you look at, voluntary codes of conduct, which are supposed to sort of cascade down the supply chain, very rarely enforced, social audits, which is sort of the go-to tool of choice, often don't tell you that much about labor conditions in a particular supplier. They're a snapshot every year, 2 years. They can often be gamed or people can be coached on how to reply. A lot of academic research shows that social audits are ineffective, but they're still kind of a go-to tool of choice, and they're something that corporations continue to lean on, at least as some proof point or validation point that they're being responsible and ensuring, that there are fair labor conditions in their operations. So you've got multi-stakeholder dialogues, which I think bring together a lot of people from NGO sector, governmental sector, corporate sector, but often have a tendency to devolve down to lowest common denominator. It can be very slow moving. So if you look at the tools that have currently been used, those are inadequate. They're not going to get us to the solutions we need. And then you start to look at innovation, and there's been a lot of interesting innovation and technological innovation that all of a sudden makes what was once too difficult or prohibitively expensive to do feasible. So, if you want to now all of a sudden understand, who is in your extended supply chain, there are AI mapping tools that can look to identify either logistics, bills of lading, financial transactions between you and your suppliers and your suppliers' suppliers, and things that would take several months to have done now can be done in a matter of hours or minutes, where all of a sudden who the tens of thousands of suppliers are in your supply chain. In some cases, you may identify suppliers that you have exposure to that you didn't even know existed. Then you can also begin to use AI to assess risk and look at different ways that there may be beneficial ownership structures associated with those companies, et cetera. So all of that basically, enables, a new level of visibility, a new level of transparency that can be done at scale. You're not asking corporations to do something that is unfeasible. And increasingly, as we mentioned earlier, actually governments are requiring that they do that. So the investment thesis then, really identifies an investable opportunity based on those trends that, the growing demand, the inadequacy of current tools, and the emergence of new technologies. I'd say, our value add really is, I think we come to this with a deep understanding of supply chains and a deep understanding of where the vulnerabilities are in the supply chain and where labor exploitation can potentially happen. And with an understanding of that and then an understanding of technology, we can connect the dots in ways that no one else is really thinking about connecting those dots.
Why, though, impact investment versus, let's say, government or regulation?
I don't think those are an either-or proposition. I think you certainly, you need policy change. You need certain things to be regulated. And you certainly need philanthropic support, and you need, workers need to be empowered. There needs to be, collective bargaining and worker organizing and all of these other things that are really critical to, ensuring that workers have a voice and are empowered. But, ultimately, even if all of those things were to happen, if you don't have the technological tools available, and this was really where, one of the key takeaways from the origins of humanity, our origins of Humanity United, where, we were putting a lot of pressure on companies, but at the end of the day, you're asking them to do something, and there need to be the tools and solutions available for them to do that, and to do that at scale and do it well. And really, no one was investing in the technologies that could address that problem in an efficient and a meaningful and in a cost-effective way. And so that's really why investment capital, we can take chances, we can try to innovate, and we can identify solutions that have the potential to really scale. That's the innovation and the solution side of the equation is something I think that had been ignored and is really where we've been able to come in and add value.
Let's talk about what you actually do. I'd like you to describe your investment process, logistically, tactically. How do you source your deals? How many deals do you screen per year? How do you get down to actually selecting and pulling the trigger on that? What's the size of investment that you make?
We're an early stage investor, seed Series A, usual check size is anywhere from, first check $500,000 to $2 million. We made a dozen investments in the first fund. We're halfway through the second fund, where we'll probably make close to a dozen as well. We leave about half of our capital for follow-on funding. I think we start by looking at those particular pain points in the supply chain and then trying to interrogate whether there are meaningful solutions to those problems. And so it can be pretty thesis-driven approach. As I mentioned, if you look back historically at some of the main areas that we've invested in, some of them are around worker engagement and trying to also ensure that we can identify high-quality worker-derived data, which I think is a real obstacle in the field overall. So I mentioned Ulula, a company that's crowdsourcing feedback directly from workers, which is far more meaningful than some sort of high-level overview of we think that people may be vulnerable in this particular area, and therefore, there's some risks. That kind of concrete data that can be attached potentially to the production of products and then flow through kind of in a chain of custody way is an area that we continue to look at as sort of a problem area. Transparency and visibility has been an area that we've looked at, and traceability. Shockingly poor practice really across the board at the corporate level. Typically, people don't have visibility beyond the first tier of their supply chain. So a lot of low-hanging fruit there to use different approaches to, get better visibility and transparency. So, I mentioned before, we've done a number of investments in AI mapping related software, in risk assessment software. So, even when you know who your suppliers are, again, there's ways now that you can ingest lots of different data sets looking at media, social media, beneficial ownership structures, other data sets, audits, social audits, public-private data, Foreign Corrupt Practice Act data. All of that can begin to potentially tell you where you have a group of risky suppliers. And, knowing that risk is important, then the next step would be, there's another pain point, which is how do you actually drive supplier improvement, right? So you've mapped your supply chain, you know where the risks are. How do you actually engage with some of those suppliers to ensure that they're being held accountable, that they're reporting information that's useful to you, that you're, helping them move up the curve and improve, whether it's their carbon footprint and or their compliance with certain labor standards. Those are all areas where, we continue to try to connect the dots. And also we'll often make connections between new technologies and, again, our understanding of supply chains, and try to figure out if there's applicability to new innovations that, perhaps have never thought of a use case in the supply chain space. So,
but you're investing in the companies that provide the technology. So how are you sourcing these deals? Like, where's your deal flow come from?
So, like many funds, we engage with incubators. We have a network of people we've either co-invested with. We're fortunate to also be part of this broader Omidyar community, where there are a number of interesting deals that are flowing through different organizations and can be referred to us. So I think, we're well positioned. We also, as I said, have very engaged relationships with corporations and corporate LPs. So they come across innovations and say, hey, what do you think of this particular company? So they can refer things to us to look at, to see whether they have the potential to be scaled. So deal flow comes from a lot of different places. We are not, sort of focused on, a particular geography in terms of where the companies are domiciled. I'd say the vast majority are Western based, but the application of their technology is in emerging markets. As we've mentioned, that's where the vulnerable workers are, and that's where the exploitation occurs. So, and increasingly, I think because of the legislation in Europe, we're seeing, I think, even more deal flow come from Europe, because the commercial opportunity there is more evident. You're seeing more later stage venture capitalists and private equity firms begin to engage in that and looking at this area of supply chain visibility, supply chain transparency, because of those legislations. So that ecosystem, I think, is that's been catalytic, and there's a lot of deal flow and a lot of opportunity in those markets as well right now.
What's your selection process to? I don't know how many deals you look at a year and how many investments you make in a year, but what's your process?
Last year alone, we looked at over 1,000 deals. About 200 of those were what we call high quality leads. Did deep diligence on about 60 of those, ended up writing investment memos for about 20 of them, and that translated into 4 investments. So it's a funnel that is highly selective. I'd say the first critical filter for us is impact. We have to believe that it's addressing a supply chain problem that can meaningfully address labor rights risks. And there are a lot of superficial solutions out there that could potentially be profitable that we look at, but end up having to take a pass on. I think, but our feeling is, before engaging in deep financial diligence and doing the thing that any other, investor would do, we have to also be highly confident and very bullish on the impact proposition. And that both, has to do with the product, but also has to do with the founders and their commitment as well. And so we often have multiple conversations with founders, making sure that they are both, committed to the social impact side of things, and also willing to work, in some cases, willing to even continue to expand the product roadmap to include labor rights related product extensions that could be valuable to them, hopefully commercially, but also which would be critical to us from a mission perspective.
Do you have anything in your process that is different than traditional VC, apart from the kind of the first screen, which is it has to be mission critical to your reason for existing?
I think the impact side goes beyond just the screen, right? So I think it does the process of both then engaging with the founder, ensuring that they're committed to the impact side of things. Then we typically will engage with them and actually put in place a side letter with every investment that will detail what we hope to accomplish. So, are we hoping to reach X million of workers? Are we looking to expand to other supply chains? Are we looking to add different labor certifications to their algorithms and their models over time that we know are high quality. Things like that, I think, are also central to what we do, of course. Yeah. But then in terms of diligence, we would look at the size of the market. We'd look at the founders and the founders fit with the product. We would look at the competitive landscape. We would, do the classic analysis that you'd do to try to identify a company that had a high quality product, a defensible position, a moat. In some cases, are they creating unique data that can be leveraged? Those types of things.
What are your targeted financial returns?
I mean, in the first fund, our targeted financial returns was kind of medium to high single-digit returns. In the second fund, we're targeting commercial returns. I don't know if we're going to be top quartile or 30% IRR. We understand that, again, going back to that funnel, there's some filtering we do that I think may put a ceiling on some of the financial return expectations. But every investment we make, we ensure that it could have at least a 3x return in and of itself. They're all very high quality, very commercially oriented investments. So don't put a single number on that, what that return can look like. I know the market will typically speak to that 30% threshold. But if you actually look historically at what market returns are, they've usually been a bit below that. We think that we can be very competitive.
So fund two, you're going for full commercial returns or near
commercial returns. Yeah.
Great. And then what about measuring your investment's impact and the outcomes? Do you have a process or a framework that you use for that and a reporting framework?
Yeah, we do. We've been very fortunate, actually. One of our limited partners, the Lotus Foundation, has also given us quite a bit of philanthropic support to bring in a developmental evaluation team that has worked with us over the first 3 years of the fund. And now, we continue to stay in touch with them. And, part of that has just been about being really clear on what our theory of change is and how we hope to change, corporate behavior and, how that can then influence this broader system that I've spoken to several times today about, kind of how the incentives are structured and how corporations do or don't pay attention to what's going on in their supply chain. So being really clear about what we're trying to address has taken a lot of time, and it's taken us, a lot of time to be very precise. We are operating in a systems environment. And so as a consequence, there are different intervention points within that system. I'd mentioned earlier, part of that is how can you get high quality worker derived information about what's going on in that first mile of the supply chain, for example. That's going to, lead to kinds of investments that can speak to, that particular problem and have metrics associated with that particular problem. But one of the challenges is they're not necessarily generalizable, and you can't get kind of an apples to apples comparison and or like a single unit of analysis that is applicable across our portfolio, right? So I think that, something that is like an Altana, which is looking at, can I map a supply chain of tens of thousands of suppliers, and can I try to assess risk across tens of thousands of suppliers? That is going to give you a snapshot that, is at massive scale, but it may not necessarily have the level of granularity or depth of something like an Ulula, which is looking at, worker related outcomes. So I think that, we look at each individual investment and we try to evaluate certain criteria that would be meaningful for it. And we want to make sure that that then is aligned with a particular area in our theory of change that we're trying to address, a kind of a systemic problem. So that's kind of the first orientation. But then, one of the challenges I think in the space is then trying to create an overarching number or picture as to what that ultimately adds up to. We have an impact report we put out every year. It talks about some of the successes that individual companies have had. It talks about some of the scale we're getting. Breadth versus depth is always, something that we pay a lot of attention to. But I think it's challenging to sort of to judge whether one of those is more powerful than the other. I think each particular platform and each particular investment that we make may have different objectives. So in some cases, we may be really looking for limited scale, but really deep interventions. And in other cases, we may be looking at, making something mass market and really having it be, highly scalable with an understanding that may come, with a little bit less depth.
Why is no one else doing this? Why do you effectively have no competition?
mean, I think that's changing, right? I think that will change, but I think it's been something that has been largely ignored, in part because of the way that globalization has evolved, right? If you kind of follow the way that we've moved away from the vertically integrated supply chain through to a model of outsourcing. And, with that, I think essentially limited accountability through that outsourcing. I think that there's a couple sides of the equation that I think have evolved. One, obviously now we're seeing is legislative, and I think there's consumer awareness of this, but also even normatively, like the UN Guiding Principles on Business and Human Rights, often referred to as the Ruggie Principles, because John Ruggie wrote those, were put out, I think, in 2011, and they push for a recognition by business that they actually do have some responsibility to what's going on in their extended supply chain. I think that idea in and of itself was, not necessarily accepted until relatively recently. And even now you're starting to see some pushback, right? As we try to add more things to, the analysis of companies beyond just financial return. Some people say like, hey, those externalities, shouldn't really matter as much. And, business's job is to make money, and like, let's not, be distracted by that. I think that we're seeing a move towards a recognition that holistic responsibility for what takes place in your supply chain is going to be expected. And I think with that comes a lot of opportunity. We've benefited historically from, I think, following in the footsteps of a lot of groups in the environmental space. So increasingly with all the net zero commitments, et cetera, people are going to already have to know who's in their supply chain and what are those people doing with respect to their carbon footprint. Nobody's been necessarily asking the questions. And by the way, since you're already figuring that out, can we also add better information about workers, working conditions, pay, et cetera? And that's a tremendous opportunity for us.
As you saw in 2010, your journey to doing shareholder activism full-time, was personal.
I mean, along the way, there were a lot of personal experiences. For instance, we moved from New York to California. And when we did, almost immediately, and we left New York, we had a son. We had a 2-year-old son pregnant with our second son. I have 3 sons. And we moved to Southern California. And almost immediately, they announced that they were going to start to spray malathion across all the homes in the San Fernando Valley because they detected some fruit flies in some backyard, lemon trees. And we were just come from New York. And we were like, what the hell? So I went to the store. I'd never heard of malathion and looked at a bottle of malathion, and I looked at the side effects of it, and we're like, holy shit, this is toxic poison. And the funny, because the announcements, they said it's totally safe, but cover your car because it might eat through the paint, and don't leave out any kids' toys because you don't want your kids to touch them. It's like, well, what about the lawn? I mean, what about just the sidewalks? Anyway, so what happened from that is my realization, my reading, led me to talk to my neighbors, which led to organizing a neighborhood group, which spread to other neighborhoods. And pretty soon there were all these parents who were, protesting at the, where the helicopters were going to take off to spray our neighborhoods, blocking the roads to hundreds of neighbors. It just started to spread. And everybody was like, no, we don't want these helicopters flying over our houses and poisoning our children. And so I realized, wow, that was just from asking some questions. Like everybody said, I have to protect my kids. So then I started, there was a thing called Big Green in California. It was a ballot initiative. And so I'm out there and I've got a stroller. I got, a little kid. I got my other son. We just go door to door. And I signed up to be a precinct captain. I'd never been involved with politics. But I'm knocking on doors and talking to people and what do they think? And I realized, wow, that was kind of powerful. Just actually talking to people one-on-one. What do they care about? What does this mean? What is Big Green going to do? That those people went and they turned out at the polls because they felt passionate about it. And so I started to understand that. And then we moved up to a little town called Ojai. Again, we land there, and within a week or two, Waste Management, the largest in the country, announces they're going to put a huge dump right in the mouth of the valley, right on top of this low-income community. And the way the winds would blow, it would just blow toxic fumes up the valley and into Ojai, which is this beautiful little, 6,000 people in this beautiful farming community. And again, we put up some signs and said, hey, we're going to have a conversation about this at the high school. The entire town showed up. We were like shocked. And we had just moved there maybe a month or two ago. So we had some friends. We had this meeting. Everybody signed up. And that turned into a 5-year organizing effort, raising money, having concerts, getting the county supervisors to actually oppose the dump. And what evolved out of it, which was interesting, is the realization that we didn't actually need the dump. That if people started to recycle and compost, there was absolutely no need. When we brought in experts and they did this analysis. So that led us into a whole campaign that actually put recycling and composting on the ballot. And it took 5 years for Waste Management to say no more. And it turned, like, I actually started to organize. I remember I was talking to the guy who ran the Ojai Valley News. They said, it was an off-year election. And only they expected 20% of people to show up. I said, if every person in Ojai voted with this turnout and the rest of the county voted for it, we'd actually win. And so the next day the headline of the paper was, Behar demands 100% turnout. And there's my picture. And I'm like, what did you do? And I'm getting all these phone calls from people, companies saying, oh, you can use all our phones, and restaurants saying, we'll feed your crew. People saying, I want to volunteer. So it's like, all right, I got to throw myself at this. And for 6 weeks, just organized people calling. And we called every person in the county, and we won the ballot initiative by 70%. So Waste Management, no more, they left. But part of it was this whole realization we didn't need the dump, that it was just, if you start thinking in a different way, and which has led to composting, recycling, all kinds of things that came out of that. So when I came to As You Sow in 2010, I had all that kind of personal background.
I think you actually, after that waste management thing, you got asked to write a strategic plan for As You Sow, didn't you?
It was actually quite a bit after that, because when my youngest son left for college in 2008, my wife and I moved up to San Francisco. We were New Yorkers. We wanted to get back into a little more city life. And that's when I bumped into a friend of mine, Tom Van Dyke, who had founded As You Sow in 1992. I knew Tom from back in 1980 when I was doing film and stuff. He had asked me we had met through mutual friends, and he asked me to make some TV ads and radio spots in New York. He wanted to close the Indian Point nuclear reactor north of Manhattan. And so I helped him with that. We stayed friends, lifelong friends. And so just had lunch with him, and he said, As You Sow has been doing great work for 18 years, but it really needs a strategic plan. And you've written dozens of business plans. Would you be interested? And I went, I don't know. Let me go look. I went in, I met everybody. I looked at what they've been doing, and just the theory of change, the idea that corporations have all this power, and that as shareholders, we have certain rights to actually ask these companies to reduce the material risk to all stakeholders. And by doing that, by making a decision at a company level, at a board level, it impacts, when Walmart makes a decision, all their employees, all their customers, their entire supply chain, millions of people are impacted. And if that decision is good for all those people, all those employees, all those customers, all those supply chains, the communities where they operate, and for shareholders, then it's a win-win. And so I saw this and went, this is actually a solution. This is a place where you can find and build solutions. And so I wrote the strategic plan, and the board asked me to stay on and execute it. And so that's what I've been doing for 13 years.
What was As You Sow pre-Andrew Behar from 1992 to 2010? And then where did you take it since then?
So it was originally founded to be a plaintiff in what are called Proposition 65 cases. So in 1986, there was a ballot initiative that was passed in California. And what it said is any person who sees that there's a consumer product, so it could be a food, it could be cosmetics, or any product that has very high levels of carcinogens and reproductive toxicants. And they listed exactly, there's 806 of them with specific levels for each of them. the company would need to either put a label and say, we have high levels of lead, cadmium, formaldehyde, or they have to reformulate. It's very simple. And that's why California is a much safer place to live than any other state, because it's the only state that does this. And it's pretty remarkable. So As You Sow was actually created to be a plaintiff in these cases. So for instance, the first cases were with nail polish, Revlon, formaldehyde and toluene in nail polish. As You Sow was a plaintiff, filed the case, they reformulated. So again, nail polishes in California are much safer than in New York or anywhere else. Anyway, hundreds of these cases. And what happened is when you do these cases, sometimes there's a settlement, and some of the money can be used for other purposes that are related. And so As You Sow, since we were back in the early days, relating to and interacting with all these companies, said, well, there's other things these companies are doing we could talk to them about as well. And that's where the shareholder advocacy piece came in, which had been really pioneered by the faith-based groups, by the Jesuits in 1970 with General Motors and apartheid. There's a whole group called the Interfaith Center for Corporate Responsibility. It's been doing this since really literally the 1970s and doing an amazing job. This whole community of folks, at Walden and Trillium and all these different socially responsible investors that have been using the power of their shares. And so As You Sow started to do that as well, specifically on environmental health issues and sustainability issues. What I did when I came in was I realized, okay, this is a great basis, but we need to be looking at energy issues, at climate issues, at social issues like racial justice, diversity, equity, inclusion, CEO pay. So I expanded out the programmatic coverage and started the first resolutions and the first engagements when I started had to do with coal ash. So Duke Power, the largest power company in the United States. And that was really about, the Tennessee Valley Authority had just had a major coal ash spill that wiped out a town of Kingston, Tennessee. And I saw that Duke is storing our coal ash the same way. What if we had an accident? This could be very bad for shareholders and for all stakeholders and for the community particularly. And so we started filing resolutions around that, which led us into the whole world of hydraulic fracturing and the wastewater disposal and fracking. So we got involved with energy, which led to big oil, starting to talk to utilities, then pipelines, petrochemical plants, which led us into banks. Actually, that happened during the Dakota Access Pipeline. All these banks were making loans to companies that were putting up this pipeline across sacred indigenous land. And the indigenous tribes were protesting, and they were sicking dogs on them and spraying them with water in sub-zero temperatures. So we went to the banks and said, hey, Goldman Sachs, Morgan Stanley, JP Morgan, Citibank, do you realize that our brand, we're shareholders, is associated now with this kind of activity? And they're like, no, what do you mean? We just lend money to this company. We don't know what they're doing with it. So, well, you should know. We should know what we're doing with it because our brand is now tied to the loans that made this pipeline possible. So that led into this whole concept of financed emissions, that when a bank makes a loan, it needs to be responsible, and it needs to also disclose that information to shareholders so shareholders can say, I don't want to be associated with that risk, or I accept that risk. It's really it's a material piece of information. Material is a very important concept, materiality. And what it means is information a shareholder needs to make a buy or sell decision. Companies are required by law to disclose that. And yet, many don't do a good job of it, and many disclose misleading information. And so this is why we're hoping the SEC, the new rule, the climate disclosure rule, which all it's about is saying when a company discloses material information, it's accurate, verified by a third party, and in a standardized format. It's the most basic function of the SEC. And a lot of people are very opposed to it. So right now, it's really about climate information. So greenhouse gas emissions, but it really should apply to any material information. So information about racial justice, about diversity, equity, inclusion. We know that those are material issues. And in fact, last year we came out with a report where we looked at 277 companies in terms of diversity, and we could see the association between the ones that had more diverse workforces outperformed on 14 key financial metrics. We're about to come out with now a new study Same methodology, but looking at 4,000 companies. So now we have statistical significance, and we have the same findings. So investors who want to place a bet, if you will, on a company and want to outperform their portfolios should be looking for companies that have greater diversity. It's just there, it's in the math. And so, again, actionable data.
Can you give me a clear definition and description of what you consider shareholder engagement, shareholder activism is?
So first of all, let's just talk about words. So shareholder activism is a phrase that has been captured by what used to be called corporate raiders, the Carl Icahn type people. So they didn't like being called corporate raiders, and so they got big PR agencies. They spent hundreds of millions of dollars to be branded as shareholder activists. So those are folks who are running dissident board slates, generally to take over a board to liquidate a company. Gordon Gekko from the movie Wall Street. We are not shareholder activists. We are shareholder advocates. We are advocating for the company. We're advocating for all the stakeholders in the company. So just language-wise, and I know that's maybe sounds like a nuance, but there is a difference. So what I consider engagement starts with research. Figure out what are the key performance indicators that you're looking for. If you look at our pesticides report, there's 35 ways that we're measuring a company. How do they use pesticides? What are their policies on it? Who set those policies? If you go to the actual report, you will see them all. And we have it, by the way, an online data visualization tool. So you can see all 35 of them transparently and how every company scores on each one. We develop these with the companies. So the metrics that we're using are the metrics by which a company will measure itself. That's critically important. Same thing with plastics. Again, we have about 40 key performance indicators. On racial justice and DEI, we have 61. These evolved from bringing together expert committees, companies, testing them, all of that. So what's most important is how you measure things. Then you have to measure things. So we have teams of researchers who go out and measure. Then engagement starts. Well, engagement actually started with the development of the KPIs, and that's an engagement because you're talking to companies, you're developing a relationship. Now you have your results, and you sit down with the company and go, hi, you scored a 7. Your direct competitors scored an 11. Here's the 2 things they're doing you're not. The cost of doing these 2 things is X. The cost of not doing these 2 things, the risk involved, means you won't be competitive. You're going to harm your brand. And so just the cost-benefit ratio is very, very in favor of doing these things. So we sit down and we do a presentation like that. And the companies generally say, you're right, or we need our scientists to look at this too. And then we work with them and they come back and go, you're right. You guys do really good research. And we're going to go and implement that. That's it. That's engagement. And that to us is how it should work 100% of the time. And it works that way about 50% of the time. Like I said, 98 companies last year out of 211. So whatever.
You're not the only people who have ESG data and scoring and all that. So there's no standardization on an awful lot of it. And that's kind of a problem that I think exists in the sustainable and responsible management business. Can you make that somehow your KPIs real, and how does it relate to what else is going on and the other tools that investors might be using in the marketplace, which management, I guess, has to keep an eye on all that too? I mean, can it conflict or not?
I'm going to call up one of our scorecards and just read you off the level of detail that we get into, because it's important to understand that. So a lot of ESG data, say from Sustainalytics, MSCI, Refinitiv, that's scraped data that the company puts out. So a lot of that is misleading. So what you've got is, just because MSCI scraped it or Sustainalytics scraped it and put it into a database doesn't make it true, doesn't make it real. And that's the problem, is a lot of people base their decisions on these data sets that are based on misleading scraped data. We don't do that. We don't think that that's a good way to do it. We have our own researchers doing our own research. When we sit down with a company, we're not basing it on hearsay. Now, we also looking at what the company stated, because in order to be material, the company has to publicly state it. But then we question the company. And so when we sit down with a company, there's a great deal of respect for the data we've gathered. And if they have a question about the data that we have, we also give them an opportunity to correct it. So we're about to publish 3,000 companies that we have researched on racial justice and DEI. We're about to post that and send a letter to every one of the companies and say, look, you've got 2-3 weeks. Look at your score. If there's anything we got wrong, please correct it before we go live. We always do this. So again, there's a respectful relationship. And that's why the engagements work, because they know that we're sitting shoulder to shoulder with them looking at a problem. We're not across the table. This is not oppositional.
Do you calculate, I guess it depends on which domain you're working in, but do you calculate the cost of not having a good score? Because I think you've referred to that this is, in the long term, better earnings, less risk for the company. Do you bring it down to hard numbers?
Well, that's why about 75% of our proposals get accepted, because we do that. So an example is, let's say, diversity, equity, inclusion. Their absolute association with a more diverse workforce outperforms on 14 key financial metrics: return on capital, return on investment, stock, just everything. And so when we sit down with a company and go, here's the numbers, you guys don't have a lot of diversity, your direct competitor does. We think that's going to mean that they're going to outperform you, which means investors are going to shift their capital toward them. Do you want to see that happen? On racial justice, do you want your brand associated with ignoring racial justice? You have not done anything positive, or you've got a lot of environmental violations and you have lawsuits with communities, fence line communities of color that you have not settled. You haven't talked to these communities. That's not good for our brand. That means that capital is going to shift to other people. Why are we doing this? What kind of decision? We sit down with companies on political spending. Sat down with Coca-Cola just to, I guess it was a few years ago now, and said, who's in charge here? Like, why are we alienating 50% of our market share? And they're like, what are you talking about? We just gave all this political contributions to all these state representatives that passed this heartbeat bill. Anyone who believes a woman has the right to choose will never drink a Coca-Cola again. Who the hell is in charge here? And they look at us and go like, we did? And we're like, yes, you did. Here's the data. And they're like, oh my gosh. Now that led to them completely reforming how they do their political spending, because no one there had a clue. We just don't think companies should be giving political money to either radical side, because you're going to alienate your market share. It's like, so those are the kind of discussions that we have.
How do you measure the results or outputs of the campaigns that you've been successful on? And how long do you measure them post-campaign? Because I presume you're arguing for a certain action in the campaign. Then if you're successful, do you continue to measure that for a certain period of time in the future or result?
So some withdrawal agreements actually have a time frame and milestones. So an example would be Monster Beverage. They scored a 0 on not one of our scorecards called Know the Chain. It's about slavery and supply chain. And so we called them up, we talked to them, they didn't want to do anything, so we filed a resolution, we got a good vote. They said, you know what, you're right. And they said, we're going to change our entire procurement system, change all of our contracts, all that stuff. And we laid out actually a 5-year timeline. This is in 2018. So what they were going to accomplish in year 1, year 2, year 3, year 4, year 5. And we have meetings with them. And they've actually outperformed every single year. They've more than hit their targets, just a complete transition. And what's remarkable is other companies that we talked to about slavery and supply chain said, impossible. We can't do this in a decade. And we said, look what Monster's done in like their first 10 months. I remember they had like trained 170 staff. They had rewritten all their procurement contracts. They'd brought in outside consultants to do it. But they changed the whole association of their brand. And that was what motivated them, is they didn't want their brand associated with slavery. And so that's the motivation. So how do we measure ourselves? We measure ourselves on companies actually making real change, that it becomes part of the DNA of the company. And so when we do check back with them, it's the relationships. I mean, our relationship at Abbott, we know they're still selling non-GMO Similac because they're making so much money at it. Starbucks, I mean, we asked them to put recycling in their stores. And here's a funny story about, do they really do it? So it wasn't us. It was somebody else, but they put a cup, a Starbucks cup, in the recycling bin, and they put a tracker on it, and it ended up in landfill. And they reported it to local press, and it became a headline that Starbucks says they're recycling, but they're actually just throwing it in landfill. They called us. Now, we had just filed a resolution a few months before about eliminating styrofoam, and they were very resistant to this. That headline hit, again, nothing to do with us, and they called us up and said, what can we do? And we're like, well, you could agree to no styrofoam across all your stores worldwide, complete elimination of styrofoam. It'll probably get you some good press. And they were like, fine, done. So between Starbucks doing that, which then led to Dunkin' doing it, which led to McDonald's doing it, 3 billion styrofoam cups are not being produced, well, for the last 3 years, every year. You're literally not producing 3 billion styrofoam cups. The demand for fossil fuels to create the feedstock for the styrofoam is no longer needed. So you're reducing demand for fossil fuels. So you can see how that's like a benefit for everybody. And it really came from, our relationship with Starbucks, that they could call us up and say, help us out. We got this bad press. We messed up. We agree, but what do we do?
That's a clever story with the tracker. How do you protect, though, against, you've got a scoring system, the KPIs, and you're going to people with a score. How do you protect against dishonest brokers from gaming your scoring system? Because as soon as you have a report card, then it's going to be like me in physics class, you're going to try to figure out how to get through this.
As a nonprofit, having a third party looking at each number, having experts in the field looking at each KPI is really the only way to do it. That we don't take any money from corporations. So we're unbiased. And so we're just looking for actual truth and evidence. And yeah, sometimes we find that companies have exaggerated or had some misleading information, particularly around climate disclosure. It's really not good. A lot of the numbers that are in the Carbon Disclosure Project, the CDP database, are very, very flawed. And they note it. They say, we didn't get accurate disclosure. We're going to make an estimate. So there's a lot of just estimated numbers, which is why rules from the SEC saying you must disclose accurately are so important. The problem right now, it's a very hostile political environment right now. And the SEC is afraid that if they put out this rule, which is just like the most the purest expression of capitalism, creating trust between companies and their shareholders. They're afraid that somebody's going to take it into the courts. It'll go to the Supreme Court, and the Supreme Court will say, no, we want to take away all your power. If they took away the EPA's power to enforce clean air and clean water, the Supreme Court is dedicated to this philosophy of neutering all the agencies. And this is there's this guy named Leonard Leo, who's basically gave us our Supreme Court, who runs the Federalist Society, who just got $1.6 billion to create this whole anti-ESG campaign. It's a crusade, really, putting out all this misleading information. ESG is environmental, social, and governance. It's a framework for assessing risk. If you, as an investor, don't want your management teams to be assessing and addressing risk, then I can't imagine that you're going to be very successful. I mean, just think about it. If you're a management team and you're making, say, T-shirts, you got to get cotton. If Pakistan has a massive flood and they have no cotton harvest, Texas lost 70% of their harvest, all these climate-induced superstorms, and you're looking at that and going, where am I going to get my cotton? And you're going to figure it out. You got a higher probability of getting product to market than somebody who says, I don't look at risk. I do not look at risk. You invest in management teams. So the whole concept of it is just anti-business. It's anti-conservative. They're using the cudgel of state government to try to tell companies how to think, how to act. And all the CEOs are going like, no, I need the freedom to operate my company, and investors I want the freedom to invest and use whatever data I need to make a decision. Why are you trying to restrict my data? And so the whole thing is really odd to me. I look at this and go, they're like anti-business, anti-conservative, anti-freedom, and yet They continue. So anyway, that's the political environment. So I don't expect the SEC rule to come out soon. But in Europe, they also are coming out with rules that are going to govern, how to describe these risks, these environmental risks, these social risks, these government risks, because all it is just risk mitigation. I mean, name it what you want. And I know they've demonized the acronym.
Do you see this culture war that's really in the US? I don't really feel it here in Europe. Do you see it impacting shareholder ability to drive corporate change?
I don't see the heads of companies taking it really seriously, other than the ones who want to hide, and they're using it for their own excuses. But the interesting thing is, actually, 5 years ago, there were a lot of companies taking credit for doing stuff, but they weren't doing anything. Greenwashing. Now we see companies actually making change, like doing good work, but they want to remain quiet about it. We call it greenhushing. And so it's hard for investors to know, how do I optimize the companies who are doing the best work? Because there are just so many trolls out there, and the crossfire is a little too intense. So the companies are doing the work, and they're just not taking the victory lap.
So can you give me an overview introduction to social finance, starting with how it was founded and its mission, get down in the weeds after that?
Oh, definitely. I think it's probably helpful to go back to the beginning briefly. We were founded, social finance is a not-for-profit company, so we're a true social enterprise, founded in 2007. In the early days of people thinking, there's this real opportunity to deploy finance in a way that delivers a return, but also generates social impact. I think quite early on, there was a sense of realization that if you're working on the kinds of problems that social finance is interested in, and we call them complex and enduring social problems, it's typically areas of acute social need, things like homelessness, around mental health, certain types of healthcare, people who've experienced prison, criminal justice, or have substance misuse issues. We're talking about quite acute social need. In the end, the scale funder, as you call it, is going to be always the government. The government, this is not groups of people who are going to pay for the services themselves. So we have to, if we existed to bring together social investors, socially motivated investors, and socially motivated or social organizations who deliver services, there had to be a third part of the triangle, which was government. And we developed a model and launched the first of these models called the social impact bond, which is essentially a partnership between a social investor putting capital into a social provider to deliver an intervention, but then government standing behind that provider who was repaying that investment on an outcomes basis. So only if certain social outcomes are achieved. And this social impact bond idea, which, really tightly linked the financial return that an investor gets with the social outcomes that the project achieves, was a really, interesting idea. And to actually make it work for the first time in 2010 in a program around supporting people exiting Peterborough prison to get rehabilitation services and effectively avoid reoffending behavior. That model caught a lot of people's attention, including Prime Minister David Cameron in the UK, but also many people internationally. And over the subsequent 5+ years, that really spread in the UK and globally. And social finance was at the forefront of that, both in terms of our UK organization, but also sister organizations that emerged in the US, Netherlands, and Israel, all closely connected. So we were very much part of that initial movement of how do you essentially bring government, social investors, and social providers together to find better outcomes to complex, enduring social challenges. Over the last sort of 7-8 years, we've slightly pivoted or evolved from that to say, our experience, and I'm sure we'll get into this, is that finance can play a really important role, but it's not going to be the silver bullet. You need quite a lot of things to be in place in order for whole systems to change to really unlock solutions to social problems at scale. And so we've become interested in how do you change systems using finance as one of several tools, and critically in partnership with many others who are also in the same, going to be allies in your same movement to to change systems. So that's how we've evolved over that period.
It was founded in 2007. You've described what it was founded to do. It was founded by Sirani Cohen and David Blood and Toby Eccles, I think. Correct me if I'm wrong.
That's right.
What motivated them to do that? And also, when they founded it, how many people? What was the initial idea?
Yeah, 100%. Now, I think that those early days in the 2000s, there were a number of organizations emerging, which were all focused on how do we had two worlds that never met. The one was the finance world, totally focused on maximizing financial returns. And then you had the social world, which was, raising donations, getting grants, trying to focus on delivering a social mission. And the two were so separate that, and this is true to this day, you get plenty of examples of charities that actually have quite large endowments where the committee that is managing the endowment is entirely focused on financial return, and the people then using, the funds coming from the endowment are entirely focused on social outcomes, to the point where sometimes those things are completely in conflict. And I think that we've, come a long way in terms of people's thinking about that. So we were very much part of this movement of how do you bridge between those two worlds and use finance to try and affect social change. And, Sirani Cohen came from the venture capital industry, founded Apex Partners, and there was definitely a sense in this of why can't we back social entrepreneurs and help them to scale their ideas? There are so many good social businesses that operate at small scale, but we should, try and push those to operate at larger scale. And, I think our evolution quite quickly came in was that, in the end, if you work on the kinds of problems we do, then there's no, multi-million, billion pound exits from those. There will never be the outsized return because effectively government makes sure that one's going to get rich off these types of programs that they are ultimately funding. And that's how we shifted into thinking, okay, this is about finance playing a role in partnerships between government, social organizations rather than, finance as the tool. It's worth saying that, in the era we were founded in 2007, there was something called the Commission on Unclaimed Assets, which was looking at how do you deploy assets that are locked up in dormant bank accounts in the UK. And there were various potential uses for this funding because these assets were going to be, they had no home anymore and they could be effectively redeployed. And the decision, came out of that, or the recommendation out of that commission was that you could set up a social investment wholesaler, which would invest in social investment intermediaries, co-invest in social investment intermediaries to support an ecosystem of these social investors who are going to go out and invest in socially motivated, in social organizations. And there was a thinking at the time, well, potentially social finance might just end up being the home for those unclaimed assets. In the end, a separate organization was set up, Fixed Society Capital, which Sirani was very, very involved in as well at the time. And that became the social investment wholesaler of the UK. And we, acted independently, became an independent intermediary, which I think helped actually, it's one of the things that helped to create more of an ecosystem along with, others like Bridges Ventures and so on that were emerging at the same time. So
they didn't see any place for this type of investment under Apex.
This again goes before my time, and I think it's certainly a reflection which we might reflect on more that the whole impact investment sector has kind of gone into slightly two ways. I mean, it's a bit of a spectrum, you could argue, but at one end of the spectrum is people who are really focused on influencing financial markets to be more impactful and focused on impact. And, ESG sits there, but also, those who are more impact focused, but ultimately are kind of sitting on big institutional capital and thinking about how do you deploy that in a slightly more impactful way. The other end of the spectrum where we're working on areas of acute social need, finance, there is no natural financial market. So you're creating markets and saying, well, in these spaces, is there a role for finance in unlocking change effectively in a way that might not come about without the use of finance? So I think that, we've seen that kind of split, and many big financial institutions will be thinking about their own impact strategies, which will look quite different to the way that we now operate in the market.
The first social impact bond was floated 2010. So there were 3 years of startup doing something. So how did it start, and then where are you today?
Yeah. And, I think it started in a basement, as all good social startups and startups should do, with a handful of people who were really focused on, both some of the early thoughts about how do you deploy this kind of capital and, developing that first social impact bond. By the time I joined in 2014, we had moved away from the basement and we were talking about, somewhere in the region of 35, 40 people. So, when I joined, we'd just started a team focused on international development. We were starting to look at, healthcare as a sector and developing, the case for, an investment fund focused on health specifically. So we would already started to explore, different dimensions of this space by the time that I joined. We're now up to 130 to 40 people. And, we've got a range of teams, which, as I say, go well beyond finance as a tool for social change.
Explain social finance's theory of change for using finance to produce transformative social impact, and make the case for how applying capital can solve social problems. And at the same time, I'd like to know what it cannot do.
Well, I think almost let's start with the last bit, which is that I think, in our experience, it's never just about the finance. It's never just that there was a program that, in the kind of work that we do in the sort of, again, acute end of need, it's never just that there's a lack of repayable investment, but finance can, unlock a different way of doing things. And I think there's a few things that we've noticed when you bring finance to the table. I think it does, we all talk in this sector about the importance of partnerships, and it is, it is really fundamental to our way of working. But I think often in the kind of partnerships that exist in the sector, people can get around the table and all say the right things, but are they 100% clear on exactly what they're all partnering to achieve? And when you bring finance to the table, it is a real forcing mechanism for creating partnerships where everyone is 100% clear on exactly what outcome we're all looking to achieve. And we're actually going to measure that. And if it's not going well, we're going to do something about it. And so that's the second point, really, which is that it does create a real focus on outcomes. It forces you to specify exactly what outcomes you want to achieve in advance. It forces you to measure those outcomes. And then, it forces a really rapid assessment of, how do we do better during the program delivery, which is something that actually, often we talk about the policy implementation gap in public policy. And, this is a discipline mechanism to make sure you're really going to follow through implementation, because there are investors sitting behind that program who are dependent on those outcomes being achieved to get their investment back and to get a return. And so they are going to make sure that there is a real focus and that we make some changes live. I think it certainly brings, a different set of skills around the table, and, that sort of focus on data, on analysis, on driving through implementation, I think is really valuable. And then the final piece is that I do think bringing finance to the table can drive a focus on the sustainability of social programs. And this is in particular contrast to, some traditional forms of grant making, where, the grant can have real impact. But ultimately when it ends, the program tends to come to an end. Whereas if from the beginning, the system that you're working with knows that it will ultimately have to pay the money back, then the business case has to be there up front for, okay, we're not sure this is going to work, so it's fantastic that someone else is willing to put their capital at risk to test it out. But if it does work, then we will pay that money back. And actually, if that business case works, then why don't we just continue to fund it in the future again as well? So even once the initial project finance comes to an end, the system has a really clear case for why it should continue to fund that program.
What type of challenges are well suited to be tackled by a social impact bond, and what kind of challenges are not?
It's a great question, and it also speaks to our evolution of the way we've evolved with the social impact bond and also evolved around and beyond it. Now, I think the key areas that it really works is where you have a very kind of well-defined group of people, usually with some quite acute need. So we're talking, as I say, about people maybe with criminal justice experience or drug and alcohol issues who are rough sleeping, for example. And where you can define a very clear and measurable outcome that we can all agree is both really important for the people concerned and the communities that they live in, operate in, but also for the system in terms of usually, got parts of government that are having to, address some of the response to these issues. So if you take wrap sleeping, for example, everyone can agree that, it's a really important issue to address. It's a very well-defined group of people. We can put in place a very specific program and be fairly sure that, because it's a well-defined group of people with an intense need, that if those people get an outcome like finding a house at the end of it, it's the result of the program that we put in place, not just kind of other factors that happened at the same time. And the outcome in terms of those people being housed, is great, hopefully for the individuals, but also the government then, doesn't have to provide services that maybe rough sleepers need. And that could potentially even be cost effective for government at the same time. So that's a kind of really nice, example of where the social impact model, you can put a program around that and it can work well. Once all those features are not present, then it's going to be much more difficult. So for example, if you're working on early years, we've often been approached to look at, could we bring social investment into early years? Often the outcomes you're looking at are very long-term outcomes. They might be influenced by a lot of different things. It's going to take an awfully long time for the investors to get repaid. It's going to be hard to judge that one program was effective, and you might be working with quite a disparate group of people because you don't know, which of the children are the ones that you really need to focus on at that point. So there might be some ways around that. But just as an example, it's more challenging to define your social impact bond program for that sort of a challenge, that sort of issue.
Social finance's first big achievement was the development and execution of the world's first social impact bond. And it was in a program involving the Peterborough prison inmates. What was the problem being solved at that point, and what was the need that led to the development of this social impact bond?
No, 100%. I think it's a great example of all those features that I mentioned. So you have, a well-defined population, which is people who are in prison for short sentences. So I think typically under a year or so. The problem is that those people coming out get very, very little support. Famously, walk out of prison with pounds in their pocket and very little else. And the reoffending rate for that group of people is extremely high. So the system as it is doesn't work for anyone. For the people concerned, they're getting no support to get back on their feet. For the system, they've just spent an awful lot of money on the police, the criminal justice process, and the prison time. And then in a very short time, they're almost certainly about to spend a whole lot more money on police, criminal justice, and prison time. So as well as the fact that for society, that person's now committed another crime, which is not great for society either. So that's not a good picture. But government also, I think, is quite sort of skeptical about, are there really programs that we could put in place that are cost effective, that we can really demonstrate actually reduce the reoffending rates of that group of people? And so the idea for the Peterborough Social Impact Bond was, if you can provide really high quality support for people coming out of prison from those short-term sentences and demonstrate that actually leads to reduced reoffending, then not only is that great for the individuals concerned, great for society, less reoffending, but actually might net save money. And the way to overcome the government skepticism was to say, actually, we'll find investors who'll put the money in up front, and government only has to pay if the reoffending outcomes are actually achieved.
So the government repays if certain criteria are met.
Exactly.
So I guess the question is, why can you achieve results that the government can't?
There's two things there. I mean, one is that government is constantly presented with business cases saying, if only you spend, when I was a councillor, I spent 5 years as the finance lead on the council. So we had a, £165 million discretionary budget, but under huge pressure from the need that we needed to address, and constantly presented with business cases saying, if only you spend £1 on this, we'll just save you £10 at the other end. The challenge the government and the Treasury faces is that, you spend the pound and then sort of the people who wrote the business case are long gone. And suddenly, the savings don't quite materialize. And so one thing was to be able to say to government, look, there's a structural underinvestment in these kind of preventative and community services because government finds it very hard to really gain confidence that the programs will actually deliver. Can we bring in investors who will put their money on the line to build that confidence and enable government to say, yeah, you know what, we'll effectively outsource the risk here. If it doesn't deliver, we won't have paid. If it does, fantastic. We'll have got the benefits that we wanted and we'll pay. So that's kind of one element, which is the sort of structural, the upfront bit of getting government to invest in these services. But I think there is a second element, which is that, because of this policy implementation gap, government finds it hard. They spend a lot of time designing policy. And then when it gets into implementation, it's really hard to keep focusing the same level of focus when programs are being delivered for, years, when there's all sorts of other political priorities that emerge in the meantime. It's a structural challenge with government. And again, this is almost, saying, can we find a mechanism that enables structurally more focus on the implementation? And so you've now, asked investors to put their skin in the game and to make sure that they will keep that focus through the program delivery on actually delivering the outcomes. And if the outcomes are not being achieved, we're going to do something about it. Not, years later when there's an evaluation and says it didn't work, but actually during the program delivery, because we're seeing that data come through live. And, although social finance itself is not an investor, one of the things I've always been most proud of about social finance is that, yes, we're involved in all the design work and the business cases and the evidence gathering, but we stick with programs through implementation. And that's such an important discipline to really make sure the outcomes are coming through in the end.
You're floating a bond and you have private investors investing in the bond to fund a third party service provider, perhaps. And the investors get repaid if the third party performs according to pre-established benchmarks. Am I right so far?
You got it.
But social finance is what, the arranger, or are you a fund, or do you have a fund that you raise and then you're like the general partner managing the service providers, or what?
Yeah, so we've played a mix of roles because I think, in an emerging sector, you almost need to dive in and play whatever role you need to. I would say the one thing, that's sort of not helpful about the name social impact bond is that it doesn't really operate like a bond. It operates more like project finance. So effectively, we're designing a project saying, right, this is the kind of intervention that we want to put, kind of program we want to put in place. Who are the partners who could deliver it? Which government departments will ultimately fund it on the basis of the outcomes achieved? What are the metrics that we're going to use? What's the evidence for how much money it's going to cost to deliver what kind of outcomes? So we do all that some design work. And then you work out your financial model and work out how much capital is required to fund the program up to the point where outcomes are achieved and payments are released by government. And then you go and raise your capital, your project finance effectively to fund the vehicle, which is typically a special purpose vehicle for that period of time. So that was kind of the original social impact bonds, really sort of project finance vehicles. We have managed a couple of funds. We have a slightly different model now. And that also has evolved over time where, yes, essentially instead of just doing it around one project, raise a pool of capital and then look at, multiple opportunities, which could in some cases be direct enterprise investments, so more traditional, or could be these kind of social impact bond investments where the return is contingent on social outcomes.
Sorry to bring up money, but this is an investment podcast. How do you get paid? Do you get a fee for arranging this? And is that benchmark based as well?
Yeah. So I think, again, in some cases, it's been the investor who's funded either, again, the initial stages or on a what we call performance management type basis. So we also will then stick with the project to work with make sure the data's being collected, run the financials, provide support through the program and so on. An investor might pay for that as well. Most of our funding now comes from doing projects and programs, usually with government partners or large international multilateral organizations. So it operates more on a kind of consultancy type basis, running projects. But in the cases where we still do work on investments, then, the investor will cover our costs.
Okay. So in the case of the Peterborough One Service social impact bond, how much was raised? What was the structure? And what was the result? Because I imagine this has come out of the wash now, right? We've got some history and you've been able to measure things.
So we raised £5 million from a mixture of, in that case, trusts and foundations. So those were organizations which were largely philanthropic, but who were really keen to try out social investment. The program started in 2010. The actual intervention ran for 2 years, which are 2 cycles of people coming out of prison. And we then measured reoffending rates over a period of time after the program ended and compared that to what's called a matched cohort. So essentially looking at similar groups of people who were coming out of different prisons around the country on similar types of sentences, similar demographics and so on. And we found in the end there was a reduction in reoffending of just over 8%, which triggered a return to the investors, a small return to investors, I should say. And that was exciting because, in the evidence base around reoffending programs to reduce reoffending, I should say, there isn't actually a huge amount of success stories. So the fact that based on a pretty rigorous, calculation of reoffending rates versus the matched cohort, the program was found to have reduced it by a significant amount.
But what were you funding? I mean, what was the service?
Oh, it was the intervention. So the intervention was a consortium program. St. Giles Trust played a big role in that, with some other organizations as well. And it was effectively, people would come out of prison and we would provide them with a bespoke individualized service. So, it was tackling whatever issue was the biggest blocker for them to, going back and living a normal life and having a house and a job and so on, which were often mental health problems for sure, often related to employment, sometimes drug and alcohol, probably often drug and alcohol problems. So a whole mix of issues. Provide, personalized support around that, some signposting to other services as well. And, just helping them get back on their feet.
And so the government repaid the £5 million investment. And then there was a return on top of that, which you indicated was rather low, single digit, I suppose.
Exactly. Yeah.
That was your first project. Your next big project was a social investment funded program running a large scale pilot program in the West Midlands. Tell me about that one.
When I joined social finance, the dossier that I was handed my first few weeks was looking at, which was a very lucky dossier. I'm, incredibly grateful for having the chance to work on this over the last few years for many reasons. But it was looking at this issue of people who are out of work with a health barrier. So typically people who are out of work for a long time have some kind of health issue. And the biggest challenge is often mental health issues. And even, when we were looking at it, nearly 10 years ago, there were over 2 million people who were in this category. So out of work, working age people, but not in work because of a health issue, 50% of which plus was related to mental health. And the reason I say I was fortunate to look at this was a couple of things. One is we saw very early on that there was a model of support, of employment support, that in multiple academic studies had shown huge promise. Success rates that were twice as good as the alternative interventions. So we started by creating a social impact bond, which is called the Mental Health and Employment Partnership program, or MHEP. That model we started in 3 areas in 2016. And the idea was sort of twofold. One was, can we test how this evidence-based model operates and delivers under different kinds of contractual and financial conditions? Up to the time, you'd seen these academic results and you'd seen some pilots. But what happens when you apply the, outcomes-based funding and, external investment? Suddenly you're going to have a different level of scrutiny on the outcomes being achieved. So the one was, do the results stand up on that basis? And the second was that one of our, beliefs about why that model hasn't scaled or had not scaled is that it was funded by, local authorities or some NHS organizations locally. But the big money for employment comes from DWP in the UK, the Social Security Department, which funds big national programs. And we hadn't yet seen DWP find ways of funding this type of model. So we thought, okay, could we use this as a test case to see if we can combine some of the local funding, which is really important because it creates that connection to the health system, with some national funding that could help to scale the model. And we brought all those different types of money together in this project finance vehicle. We raised investment from Big Issue Invest, and we started deploying it in 3 areas in 2016. And we had opportunities to continue to expand that model to up to 14 areas by around 2019-20. And it's currently now the project's coming to an end to the other side. And during that time, over 2,000 people with severe mental illness, learning disabilities or drug and alcohol conditions have been supported to find paid and fulfilling work.
To get this in my mind, the investors are like limited partners, and then there's the people that you're investing in.
Yeah, I mean, I think we generally call ourselves the intermediary, sort of broker, bringing the pieces together. Yeah.
So you're actively involved with the service provider, whereas the investors are not.
Yes. I mean, we certainly, they, the role that we've played is to, help find the service providers, working with the local authorities, councils, NHS trusts that are involved. And then as the investment runs, we will have the direct relationship with the service providers. Exactly.
Is there a typical maturity you would expect a bond to go out for?
I mean, I think we find that, almost the longer the better, in terms of really allowing programs to mature, to learn, to get results. When we started this mental health employment partnership program, it was originally a 3-year program, but we were able to continue to extend it, through various means, raising more money, raising more capital, raising more, outcomes funding. And, as I say, that's all now lasted. It will, if it probably comes to an end this year, it will have lasted around 8.5 years. So that's probably one of the longer ones.
So they're typically, if you had to pick on
3, I would say 3-ish years. Yeah.
Okay. People want to see that it works, I suppose.
Yeah, and typically it's hard to secure actually the outcomes funding from government for longer periods of time. So they don't want to lock up their money for budgetary reasons as well as anything else.
Is there an expected rate of return that one would expect from a social impact bond?
Again, I think it is hard to, it's hard to pin down. I think in the end, we are talking about, social investors putting their capital at risk and, looking for, broadly speaking, sort of high single digits, I would say.
How did the founding of Bethnal Green Ventures come about?
There was a bit in parallel with School of Everything, which was that I used to help organise these weekend events that we called social innovation camps. And they were partly a kind of hiring tactic for School of Everything, in that they brought like interesting developers and engineers into the building where we were based. But they were also based on this thing we'd noticed, which was that really talented developers, designers, entrepreneurs wanted to work on social and environmental issues. And they weren't getting the opportunity to do that in their day jobs. So most people in tech at the time were working for banks or advertising agencies or, those kinds of companies, and actually weren't working on stuff that they really cared about. And so we gave them the opportunity at the weekend to come together and get together in little teams and try and hack together a prototype of something that might have a positive impact. And the energy around those was amazing. I recognized that community of people actually were looking for somebody to help them make the first step from just having a prototype to turning that into an organization or a company. And that's where Bethnal Green Ventures came from. We thought, okay, well, we've got this community of people that we know are passionate about trying to put tech to work for social and environmental goals. What do they need? And they all said, oh, well, I need a bit of money to help me quit my job and turn it into a startup. And that's where the idea for Bethnal Green Ventures came from. Got together with a few other people, and we managed to talk Nesta, who are a foundation in the UK, into investing. I think it was about £150,000 at the time that we could invest in the companies. Google gave us a little bit of space in their offices near Old Street. Called on loads of sort of contacts who became mentors and helped the startups get going. And in 2012, we backed 6 companies during the summer, right in the middle of the Olympics that was going on in London, which was a terrible time to try and organise anything because the logistics of London were not perfect at the time. We ended up having to house all of the founders who came from outside of London. We rented a house for them for the summer. And quite a few of them ended up sharing beds, let alone sharing rooms, because there just wasn't enough space in London that summer to get everybody in. So it was great fun. And I know, make no bones, but we got very lucky in that 2 of the 6 companies that we backed that summer became multi-million-pound businesses. So that enabled us to then to grow from there really and raise more money in order to back more startups that had that social and environmental goal as well as the high growth goal.
You founded Bethnal Green Ventures with an impact angle to your strategy at a time when this was highly unusual for venture capital to do this sort of thing. What did you see then that led you to build a firm to invest in it?
It was partly the talent of the founders. There were some genuinely brilliant people coming to us and saying, I don't know where else to go, because the mainstream VC world thought that what they were trying to do was charity. They thought it was that it's charities that have social impact. And they were literally getting turned down saying, I think you should start this as a charity. But then on the other side, the charity world was saying, we can't fund businesses. We can't fund things that are going to be revenue generating. So where do I go? And I said, I think I might have an answer. And also, I think at that time, impact investing was still quite, I don't know how to put it. It was a bit in the helicopter position. It had been talked about in very high level forums and all this stuff, but the implementation of impact investing was still very early back in 2012. So because we were small, we were only trying to raise small amounts of money, we were able to actually put things into practice very quickly. And so I think our timing was lucky, to be honest. It felt like there was a lot of resistance to us because we were so early, and a lot of people told us we were mad, but actually that enabled us to innovate and try things in the gaps and the cracks between everything else that was going on. And we managed to certainly attract the best founders at the time because they had nowhere else to go. That's what we built from, I think. But yeah, we've always had this two parts of the thesis. One is that, we believe that impactful tech businesses will be the most valuable businesses of the future. We think that the companies at the top of the stock market in 10, 15 years time will be the ones that can really demonstrate they have a positive impact. And somebody's got to help start those. And that's where we come in. And then the other side is that we really believe that in diversity of founders, so that you don't just want to look for the usual suspects of sort of the tech world to create those kinds of businesses. You need real diversity of thought and background and approach in order to do that. So that's what we've ended up with, is this incredible portfolio, if you like, of companies that are driven by an ambition to have a massive positive social impact and financial gains. But they are also a really quite an unusual bunch of people, which makes it a lot of fun.
Can you give me a high-level introduction and overview of Bethnal Green Ventures?
Yeah, Bethnal Green Ventures, we set out to invest in and support founders who want to use technology to have a positive environmental, social impact and build high-growth companies. We don't believe it's an either or. So we're looking for companies where essentially we think of the world as a Venn diagram of, high growth, high profit and high impact. And we're looking for the intersection between the two. We don't think of it as a spectrum in that way. And our strategy is to invest in them very early. So we think that we've got a lot of experience in our team and in our networks of helping companies from pretty much day one. So when you've got founders who really understand a particular problem that they want to solve, but might not have experience of growing a company or of building a team, all those kinds of things. So we help them from pretty much day one. So usually we want to see a prototype of something that they think can turn into a product that will help people. We're almost always the first investor in. And the way that we invest is through cohorts of teams. So typically we invest in about 10 companies at the same time. We introduce all of those companies to one another. So they create a bit of a support network amongst each other. We give them access to all the materials and the networks and resources we think they might need to get them all up to the same speed and the same level of expertise in company building, if you like. And then the ones where they do find something that really meets a need and starts to show promise, then we make a further investment at that point and help them to grow. And then we fund them through to their seed round. And at that point, we start to hand them over to other investors. So that's our model. We have 3 impact themes that we're particularly interested in. So they're a sustainable planet, an inclusive society, and healthy lives.
How many employees do you have?
Well, there's 7 of us in the BGV team, in the core team.
Is it one fund or do you have multiple funds?
Yeah, so we've been going for 10 years. We've had a mixture of different types of fund over that time because we've found ourselves actually, I guess, in some ways, the biggest struggle we've had has been fundraising. It's been challenging, partly because in the early days, people thought we were mad. there was definitely an element of, can you have a venture capital fund that has an impact? That changed, I would say, around 2015, 2016. So our first fund was very much prototype, and that involved Nesta, the foundation, who were one of the LPs in that. And then they were joined by Big Society Capital, who are the main wholesale impact investment fund in the UK. And they helped us to scale that up. And then we shifted after that fund. We tried to raise a larger institutional fund at that point and failed. We couldn't get buy-in from any of the sort of common LPs into venture capital firms in the UK. They still really didn't get impact, I don't think, at that stage. So we actually switched strategy and started raising money from high net worth individuals directly. And we raised these annual funds through there's a tax relief in the UK called SEIS or EIS, which helps early stage companies to raise money from high net worth individuals. And we started raising those on an annual basis. And we've raised 5 of those over the last 5 years. And we've invested that alongside some institutional money from people like Big Society Capital. So that's been the evolution of our LP base, if you like. And we are now raising a larger institutional fund, and that it's now, I think it seems there's much more appetite from those kind of investors for impact, which means that we'll be able to scale up.
So you have multiple funds then?
We've got 7 funds that are, in the some of them are fully deployed, some of them are in the exits phase, and some of them we're still deploying.
So these are closed-ended funds then?
Actually, we have a bit of a mixture. So our first fund, because we set it up as a prototype, actually started out as an open-ended fund. However, we decided to stop investing from it a couple of years ago and shift to closed-ended funds just because they're more normal in the venture capital world. So yeah, we did have an open-ended fund, but we're now focusing on closed-ended funds. And
do you publish your AUM?
Yeah. So far we've invested about £10 million. Hopefully that's going to go up quite significantly in the next few months as we raise a new fund. But yeah, we've only invested about £10 million so far. But yeah, backed some really good companies with that.
I spoke some time back with Ben Rick at Social Sustainable Capital, and his experience has been exactly that. He was saying in the early years, they couldn't get it, they didn't understand it, and now they're calling him and he's getting a lot of interest from that. You have focused on what you call tech for good. What is tech for good? What's your fund's theory of change? And is this an approach or a process or an asset class? Help me understand this.
Yeah, so for us, tech for good is very closely linked to sort of the GIN's definition of impact investing. So we're looking for companies that are intentionally trying to use technology to have a measurable impact. So the 2 key words, intentional and measurable. So that's our definition of a tech for good startup, is one that is intentionally trying to have a positive impact in a measurable way and also deliver a return to its investors. That's our definition, if you like, of tech for good. As I say, the reason we think that makes a good investment is a very big kind of macro question. We really believe that in order to maintain trust in both technology and even to some extent capitalism, in terms of like the way that companies work, companies are going to need to demonstrate that they have a positive impact beyond just delivering a return to their shareholders. And so we believe that the big companies of the future will be the ones that do both, the ones that show both a positive return and a positive impact. And we don't really believe, looking at the stock markets of today, that the current incumbents of those markets are going to be the ones that deliver that. We think it's going to be new companies that come up. Maybe some of them will be acquired and merge and so on with other companies, but we think that there is a huge growth potential for companies that are founded at the moment to become the big companies of the future, provided that they can demonstrate that impact and obviously that financial success as well. And that's what we're trying to find. That's what we're trying to get in on those early, because it's incredibly risky. Most of them will fail. But we think that if we can build a large enough portfolio, so if we can diversify ourselves enough, then a handful of them will become those big companies of the future. And that's basically the thesis behind BGV.
What's your theory of change?
The theory of change is that by providing capital to motivated founders, motivated and I guess like capable founders, that we can essentially change the idea of what a tech startup is. That's really what we're trying to do. So we're trying to make it incredibly desirable and positive attribute of startups that they should have a positive and measurable impact as well. And we stand to benefit obviously from that if we're the investors in them. But we're also fine with loads of other people doing it as well. If a lot of other investors start to do tech for good investing as well, that's also very positive in terms of our theory of change. We're trying to change the whole of the early stage tech market. I wouldn't claim that we're responsible for all the change, but it definitely has changed over the last 5 years. The number of new funds that are trying to do impact tech or tech for good, the number of mainstream funds that have hired people or that have added impact and tech for good to their strategies is brilliant. We think that's all great. And the more the merrier as far as we're concerned. So that is also part of our theory of change as well, is that if we can make it more desirable, we can make it seem more attractive, we can show that you can have success by backing these kinds of startups, then we change the whole of the early stage tech market, which moves, hopefully in the end delivers greater positive impact for society and for the planet as well.
How should I think about tech for good? Is it a sector, or is it an approach, or is it more about the founder's intentions?
I think it's an approach. I think we would describe tech for good as an approach. It's very entwined with the founders because it's the set of questions you ask yourself when you're creating a business, which is automatically incumbent on the founders. So what's the problem we're trying to solve? We have a particular methodology for unpacking problems, so it's at different levels, in order to make it addressable by startups. And that's an approach, if you like. So the way that we unpack the social or environmental problem that they're trying to solve, that's part of the approach that we expect from our startups. I don't think it's a sector because it sort of transcends other sectors. So it makes it difficult to call it a sector in and of itself. We have healthcare startups, we have, climate change startups. But then having said that, I wouldn't say that all healthcare startups are tech for good startups. For example, I think you can get healthcare startups where actually you're not necessarily trying to solve a particular sort of social problem. You're just, you potentially could reinforce existing social problems or social inequalities through backing that kind of startup. So I think it's an approach rather than a sector on its own.
Most people are fairly familiar with venture capital and the concept, but what you're doing is different. So how does impact venture capital investing differ from other types of impact investing?
Yeah, I think, I'm sort of good friends with a lot of people who would describe themselves as impact investors, but in very different asset classes to what we do. And I think one of the things that we often find ourselves talking about is the impact that we can have as investors as well. So there's obviously, as an impact investor, you can invest in impactful companies, but you can also have an impact yourself on those companies. And certainly some friends I have who, let's say, are doing impact investing, but let's say in public markets, they're a little bit jealous of what we do at BGV because we have such a direct interaction with the companies that we work with. We're so able to get involved as their strategy is formed and as they put in place their impact management and their impact measurement and all those kinds of things. We're so able to have an impact on the companies themselves. That's one of the things that I think makes impact VC quite different from a lot of other forms of impact investing, is just the directness of the interaction that we have with those companies. And that's, I mean, I really enjoy that. I think that's, I probably wouldn't do it if we didn't have that, to be honest. I'm not sure I'd be a great investor in sort of public markets and that kind of thing, because I'd get frustrated at the inability to actually like help those companies get better. That's a big part of what makes impact VC different.
I guess maybe the confusion comes in that there's a lot of investments out there that have the impact label.
I think that the definition of impact investing, certainly in the UK, is firming up, I would say. It feels much clearer to me now than it was even sort of 2 or 3 years ago, around this idea of intentionality and measurability, basically. So, there's, and it's creating quite a useful contrast with ESG as well. So I think we're starting to see like a clearer division between what's ESG, what can you consider to be, an ESG fund, if you like, and what can you consider to be an impact fund. I think those two things are starting to separate, whereas a few years ago, there was all kinds of like sort of muddiness almost around what was what. I think ESG is certainly being seen as more like kind of process driven. It's more about risk management and all those kinds of things. Whereas impact is more like investing for a positive outcome or a positive measurable impact. And that's quite clear now, I think, certainly not in the sort of general public, but in the financial services world, it's becoming clearer that, and actually even by the regulator as well. So I think it's quite likely that the FCA in the UK they're about to announce their sustainability disclosure regime, and it's quite likely that they're going to make a division between the two as well. So there'll be if you claim that you are going to create a fund or you're going to have a fund that has impact in the name, then it does have to go above and beyond what we commonly understand as sort of an ESG fund. And I think that's a good thing.
Are you typically making equity investments or debt and equity?
Yeah, so we're predominantly equity investments. If we do debt, it's usually convertible debt. And it's for reasons of being, needing to be a convertible note for sort of just practical reasons at whatever stage it is. But yeah, no, we're very much equity investors. We even if we're using debt, we're thinking of it as equity. And
do you have target returns that you communicate to your investors? And if so, what are they?
All of our funds, roughly speaking, target a 20% IRR. So that's essentially means we're looking to provide kind of 2 to 3 times people's money back, but over a 10-year period. And the performance of our first fund is in line with that. That's part of the reason for being able to sort of say that. And I think we've learned, certainly by, talking to and seeing a lot of benchmarking and sort of more mainstream venture capital funds, that's no different to most European early stage VC. So we certainly don't think there needs to be a lower return because we're tech for good VC firm or an impact VC firm. And actually, I think it's very hard because there's not enough of us yet to have proper benchmarks. But certainly, my feeling is there's not many sort of poorly performing impact VC firms at the moment. So I think the balance of the impact VC firms does seem to be towards the better performing ones, but it's still early days, so it's very hard to be able to say that for sure. But I think there's a lot of thought goes into designing impact funds because you have a lot more information to think about. And I think that leads you to actually have very well run firms. That's not going to be the case all the time. I'm sure there'll be some bad ones that come along and some people who say they're impact and aren't and just don't do it well. But at the moment, I think there's a really good cadre of impactful VC firms that have been set up over the last few years in Europe, which I think is very positive for the future.
Can you describe your exit strategy? How do you approach your investment exits?
When we set up, I think we assumed that our exits would be trade acquisitions. So, our companies being acquired by larger companies. And that has certainly been the case in several of our exits. The thing we didn't predict, which has been the case with a couple, is essentially very successful secondary transactions where later stage investors have come in to become investors in our companies at, let's say, Series B, Series C, and they've wanted to acquire the shares of the early investors as well. So they've still got, they're still backed by investors rather than being wholly acquired, but those investors have bought out the shares of the early investors for a good return in our case. So we're seeing a mixture of acquisitions and secondaries as our exit at the moment, and hopefully in the future we'll do IPOs as well. But yeah, so far we've seen a mixture of acquisitions and secondaries.
And what do you do to make sure you're investing in businesses whose impact can be preserved after you have exited? Because that's the point of it all, isn't it?
For us, that's about linking the business model to the impact. So if the business model, so the engine, if you like, of economic value is linked to having a positive impact. So effectively, if the company has more impact every time it sells a unit of its product or service, then that's very positive. And it means it's very likely that impact will be preserved after an acquisition, because usually in an acquisition, the thing that is being bought is that economic engine. And so that's one of the reasons why we spend a lot of time in the early days trying to help founders to link their business model to their impact, and making sure that the two are aligned, partly because we found that that's the best way of preserving the impact should they be acquired by another company.
How do you screen your deals? What is your due diligence process that gets you to the point of pulling the trigger? Because you're investing in businesses at very early stages. So can you walk me through that?
So the way we do it is being very public about it, essentially. So twice a year, we open up a call for applications, we call it. And typically we have hundreds and hundreds of small teams who apply to us for investment. Last one, I think we had 300 or so ventures who applied for us, and we choose about 10 of those. So it's a very competitive process. So that's the first step, is to make sure that we've got a very large number of people that we can essentially choose the 10 best, if you like. And the way we do that is people apply online. Then we use our community, our network, so the BGV team, but also our mentors and some of our previous portfolio founders as well, to shortlist down those 300 and to score them against a variety of criteria, which are things like, the potential for impact, the potential of the business model, the potential of the team. That gives us a group of, let's say, about 50 companies, and we interview all of those teams. And there we're looking much more at the team. So that, that's very much about the quality of the entrepreneurial quality of the team. Do they have a really good mix of skills and mix of approaches in that founding team? It's rare for us to back sole founders, as they tend to be called. It's typically we're backing teams of 2 or 3 people. And after that interview, which also includes some of our portfolio founders, some of our mentors. So we've always got people that we can bounce ideas off as the BGV team in terms of thinking about these teams. Again, we score them mainly on the team at that stage. And then we make offers to roughly speaking, the top 10. And when you do that, like every 6 months, which is what we do, you start to see some patterns. You start to sort of get the warning signs, if you like, of things that don't work. I mean, we've backed over 170 companies now over the last 10 years. So, and screened thousands and thousands of them. So you learn these tells, if you like, of like what makes a good team, what makes a good product. And I think one of the most important things for us is, can the team teach us something about the problem that they're trying to solve? So do they tell us something we don't know about the problem? So do they have a unique insight into what people who face that problem are going through, or the way a particular industry is failing to tackle a particular environmental issue, or that kind of thing? So that's a very good indicator for us, is if they can teach us something about the problem they're trying to solve, that's often a very good sign that they've got something unique that hopefully, you obviously have to look at it, but that could grow into a really successful business.
Right. Is there any particular angle in terms of technology?
We're fairly technology agnostic, actually. I think we like to be convinced by the team that they've chosen and thought about the technology that they're using in an appropriate way. So we want them to be able to prove to us that the technology they're suggesting as a solution is the right one. So we don't automatically think, oh, I'm sure AI could solve this, or, I'm sure this should be a hardware startup. Again, we're led by the understanding of the team about the problem as to whether the technology is a right fit. Having said that, we are to some extent a bit limited because we make very small investments. We don't have hundreds of millions of dollars to invest in these companies. That really limits the profile of the technology that we can back. So hardware, usually there's certain kinds of hardware that we can back with our profile of capital, but it's a small fraction of the startups we back are hardware, to be honest. And then likewise, there's also the time scale of the technology. So if you're talking about medical devices, for example, that just the time it takes to get all of the approvals you need means that we've probably not got enough capital to back a company like through all of those stages. So there are limitations on what we can back, but they're generally driven by the amount of capital that we've got to invest.
What is your average ticket size that you put into these companies?
When we first started investing, our first investment was £15,000. So, that's grown to be more recently £30,000. And we're just about to increase it again to £60,000. And that's really a reflection of actually confidence to some extent of the companies are coming to us slightly better formed, if you like, as time goes on. But our first investment is a few tens of thousands of pounds. And we're very deliberately, that's about helping that team to try things out. And then if those things start to really show promise, then we'll invest a bigger ticket. That first investment is a few tens of thousands of pounds.
And do you have co-investors?
Not for the first investment. The first investment we almost always do on our own, and we're certainly not dependent. We don't wait until other people join. The follow-on investments, almost always we're doing that with other investors as well, whether that's angel investors or other funds.
So you are essentially family and friends investors for founders who have no family nor friends.
Yeah, it's a very good way of putting it. And the venture capital business has huge problems with diversity. And I think when you look at our portfolio, it is much, much more diverse than most portfolios of venture capital firms in Europe. And part of that, I think, is the fact that we go so early, the fact that we're able to be that kind of friends and family round for people who don't necessarily have friends and family. And so, we've very deliberately gone out to try and find diverse founders, but our model helps us with that because we're able to put that money in where, maybe slightly more usual suspects would get that money from, sort of wealthy friends and family.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.